Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about why you should never pay tax on your rental income. So if you're someone who owns real estate investments, whether it's actively yourself where you're going out and buying and managing properties, or if you invest passively like I like to through funds and syndications, you can check out this video to understand why you should generally not expect to pay any income tax or in some cases capital gains tax on the income from those investments. So I want to be clear that I'm really talking about in this case when you rent out properties on a long-term basis. So whether that's residential properties that you rent out, on a month to month to a tenant who wants to live there, or commercial properties that you're renting out maybe on an annual basis, whatever it is, I'm talking about long-term rentals. I'm not talking really about the short-term rental strategy where you're going to own properties that you list on Airbnb or VRBO. A lot of the concepts I cover in this video will apply to those, but I'm really here focusing on those long-term rentals and why you can expect to set this up in a way that you should never pay tax on the investments themselves again. So I'm going to start with explaining to you why you shouldn't pay income tax. So when you own a real estate, investment, you buy a property, you rent it out, and you get rental income from the tenant. So of course you're going to have some expenses that you have to, pay for the property as the owner. Those would be deducted against the rental income. But if it's a good investment, you should be getting net positive cash flow every month from owning that property. What happens though is on your tax return, even though you are getting net cash flow positive, putting in, to your pocket every month, for tax purposes, you should be showing a net loss. So I want to be clear that this is not saying you should be losing money on your real estate investments. That is 100% not the case. If you are, that's a bad investment. You should be making money on it, but on your tax return, it should look like you're not making money because you're not going to show a profit. So with that said, I'm going to dive into the concepts. I'm not going to discuss them in detail. If you want to learn more about these, I suggest you think about, looking and researching these further. For most of these, there's a lot of information out there on the web about this. Real estate investing is very popular because of the tax benefits. And I want to be clear that my personal opinion is that if you're going to own real estate or invest in real estate, and you're not going to use debt and you're going to pay tax for some reason because you're not setting it up properly, I don't really think real estate investing makes any sense in that case. To me, real estate investing is so great because of the tax benefits that you get largely, and to some extent also the ability to use leverage to increase your returns. So in this video, I'm talking about the tax benefits of real estate investing. If you want to understand better my view on the overall benefits of real estate investing, both tax and non-tax, I'll link below in my comments to my asset allocation series, part 6, where I talk about real estate and I cover that in more detail. So check that out if you want to see, more commentary of my thoughts on the non-tax benefits. So here we're going to focus on the tax benefits. I'm going to talk to you about first the income tax benefits. So that's why you shouldn't be paying tax on the income you get, the rental income. And then on the next slide, I'll talk to you about why you shouldn't pay tax on the capital gains you get if or when you go to sell the properties in the future. So I'm going to start with the one that's probably the most common. Most of you have probably heard of that, and that is depreciation deductions. So depreciation deductions are basically just really large deductions you get for the value of the property that you buy. When you go to buy a property, you're going to have to allocate the purchase price that you paid for that property between the building and between the land that the building sits on. You want to, have as much allocation as possible to the building itself and any fixtures that sit on the land, because those give you a tax deduction for depreciation. Any value of the purchase price that's allocated to the land, that is not deductible, and you're not going to get any benefit or any tax benefit for that. But anything that relates to the building itself that sits on the property, if you have a sidewalk, things like that, where there have been improvements on the property, or if you add additional fixtures or whatever to the property going forward, that can give you a tax deduction. Those tax deductions are quite large, and we call those depreciation deductions. Those deductions in and of themselves can, in many cases, wipe out all of the taxable income that you would pay. So you may find that you don't even need to do the rest of this stuff because you may find that depreciation deductions themselves are so large that you're not going to have any net income for tax purposes. But regardless of that, you still want to take advantage of these other ones because you could have a situation where you're increasing your rental income, in the future, and you did start to have positive, net taxable income. So don't fail to take advantage of these other opportunities to you, because you want to build up those tax losses. In some cases, those tax losses can be used to offset, other income. So you want to make your rental loss as high as possible. The second benefit, which is it is a type of depreciation, is that you can claim bonus depreciation. So there is a ton of materials about this online. Check it out, research about it, Google about it if you want to learn more about bonus depreciation. But if you own real estate, you should definitely be taking advantage of this. Bonus depreciation basically lets you take larger deductions sooner for certain types of property. So that type of property, it's not going to be the structure itself, but it's going to be smaller types of property. So it can be things like appliances. It can be things like, carpeting. It can be things like plumbing, air conditioning units, furniture that you put in the property if that's the case. So you can claim larger deductions for those types of property sooner. And in 2024, you're actually allowed to take 60% of that bonus depreciation this year. So that is a huge benefit. And it was previously 100%, but it goes down 20% every year. There could and quite likely maybe will be a law change in the future that kicks that back up to 100%. But under current law at the time I'm recording this video, it is 60%. If you're watching this video, later in time, check out if there's been a tax law change there, because it's likely, and Congress does want to kick that back up to 100%. But, 60% is still great to claim that bonus depreciation. This means in earlier years, you're going to have huge deductions on your tax return in addition to your regular depreciation through bonus depreciation. And that's going to increase your losses that you can carry forward and offset rental income in the future. So don't fail to take advantage of this. You would typically do this by doing what's called a cost segregation study. I'm not going to go into that in detail, but basically that just allocates, here's the value of the building from what you paid for the property or what you've, built on and added on yourself and improvements you've made. And here's how that amount is allocated between all the different assets. So don't spend a lot of money on cost seg studies. There are DIY cost seg studies. You could always get audited, but, do a cheap cost seg study. It's really not rocket science. Don't pay a ton for it, but it's definitely something that you're going to need to do if you want to take advantage of bonus depreciation and the benefit there to its fullest. Next is interest deductions on debt. So I said at the beginning, and I still repeat this, if you're not going to take advantage of the great ability to usually get low cost borrowing in order to finance, real estate. So that's going to be a mortgage, when you're talking about going out and buying a rental property. Right now, as I'm recording this, interest rates are a little bit higher. We're in, a little bit of a higher interest rate environment. They're still not super high based on, historical rates and as well as like other forms of financing. So, when interest rates drop, to fail to not, take out a good bit of a mortgage on that property, I think is a big mistake. Assuming you know what you're doing and you're not going to get yourself in trouble by having debt. Real estate debt is good debt. And again, if you're smart and a savvy investor, you should, I think personally, be taking advantage of that. I take advantage of good debt as much as I can, to the extent I can get, low cost borrowing on that. And you're going to get tax deductions for the interest expense. So from just both a tax and non-tax standpoint, it just doesn't make sense to me not to take advantage of the ability to use debt on real estate. In good interest rate environments, you can get low cost debt. If you're someone who's got, a 3.5-4% mortgage from the past, then, you would be crazy to pay that off sooner than you need to. So don't fail to take advantage of this. You do get interest expense deductions on your tax return, and that's just another deduction that can offset taxable income in the future. The fourth point I want to make is that when you are investing in real estate, you should be treating this as a business. So this is not true for people like me who go out and, at this point in my life, this has not been the case in the past, but at this point in my life, I'm only investing in real estate passively through funds and syndications. I don't want to mess with it. I'm happy to pay someone else to do it. But if you're going to go out and buy properties yourself, you should be treating that like a business, because that's what it is. So in that case, you're going to be able to take tax deductions for your business. So the same way that I can take deductions for, my business that I run, I can take deductions for a lot of different things. For this space in which I'm recording this video is tax deductible. Anything I spend, on my business, if I were to, when I used to have a client service business, when I would drive to meet with clients and stuff like that, those types of things are tax deductible. So when you're driving to your properties to check them out, when you're, you need to set up LLCs, treat it like a business, take that, annual trip where you can deduct for your annual LLC meeting, those types of things. Make sure you're taking the tax deductions and treating this as a regular business. People don't think of real estate investing when you own properties yourself as a business, but that is. If you're going to go out and buy properties and manage them yourself, that is a business, and you should get tax deductions for the expenses that relate to your running of that business. So don't forget to do that and to think about it that way. So those are the reasons why you shouldn't typically expect to pay income tax on rental income. Now I'm going to talk a little bit about capital gains tax. So before I was talking about, here's why you're typically not going to be paying tax on your rental income that you make every month, or, however often you get paid from your tenants. But let's think about, so that property has increased in value significantly. We've got a lot of this depreciation in there. I want to access that depreciation. Maybe I want to sell the property. Maybe I just want to, take some money off the table and put it into something else, or go out and buy a new property. How do I do that? By not paying capital gains tax. So again, there are great tax planning opportunities with real estate. Some of these aren't available with other asset classes. So, it's great to take advantage of these, because if you can avoid tax on the rental income, and then if you can avoid tax on the appreciation while you're still scaling up your real estate business, then that is a great opportunity that you just can't beat. So there's really two ways to do that without, avoiding paying tax or capital gains tax when you sell the properties. And in some cases, you don't even need to sell the property. So the hallmark of a really good asset is that you can access appreciation in that asset without having to pay tax on that gain. So you can do that really one of two ways. You can access appreciation by doing what we call cash out refis. So that basically are just refinances of the property where you take money off the table. You can, get access to some of that appreciation. So let me just tell you a little bit about how that would work by using an example. Let's say you had a property that, was worth $100,000. I'll just use a small number to keep it easy. And you put down $20,000 on it and got a mortgage for $80,000 to buy that property. Let's say 10 years in the future, the property is doubled and it's worth $200,000. How do I access that $200,000? So I have a $100,000 gain in there because I paid $100,000 for it. It's now worth $200,000. How do I access the benefit of that appreciation, that $100,000 appreciation, without having to pay capital gains tax on $100,000? So I can do that by refinancing the property. Before I had an $80,000 mortgage. Now I can refinance, put my 20% down, or whatever the bank requires you to put down, and then get a mortgage for the extra. So, for example, as before, maybe you have to put $40,000 down if they're going to require you to put 20% down. And then you can take the rest, the other 160 out as a mortgage. You can use that to buy a new property. You can invest in a completely different asset if you want to. So cash out refis are the way that people access appreciation in the asset by refinancing the property. You want to do this generally in a low interest rate environment, if you can, because you can, again, get great advantage of low cost borrowing there, and you can get the appreciation. You're accessing the appreciation. You still own property one, and so that's great. So you're still getting the additional rental income from that. You're still getting further appreciation in that property, and I can take that money and I can go invest in something else. So that is a variation of the buy, borrow, die tax strategy. If you do not know about buy, borrow, die, you need to learn that. I'll link to my video on that below. And that is the most important tax strategy out there. You need to understand that concept, to understand how wealthy people make money with paying little to no tax. So this is a great way to do that. If you're going to really get serious about your real estate investments, you need to think about cash out refis over time to be able to take advantage of the appreciation in your properties without paying capital gains tax. So the last point, I'm not going to dive into this in detail because there's a lot of, requirements and rules around how to do this. But under current law, we are allowed to do what's called 1031 like-kind exchanges. So basically what this allows you to do is to take one. So I own property one now. I want to sell property one and go out and buy a different property. I'm just, I'm done with this. Maybe I I've made so much money from that property that I'm ready to buy a bigger property that I can rent out for more money. So what I can do is I can exchange property 1 for property 2 and avoid paying tax on the gain in property 1. So this is a great way to scale up your real estate business over time. People do 1031 like-kind exchanges by rolling up properties over time. So maybe I'm just starting out. Let's say I don't have a lot of money. I buy a $100,000 property. Let's say that property does really well for me, and in year 5, I'm ready to buy a $250,000 property. I exchange $100,000 property for $250,000 property, and then maybe 5 years later, I can do a $500,000 property that gets me a lot more rental income. So I can just keep scaling up my real estate business over time, buying, more expensive properties that I can afford in the future, and I can do 1031 like-kind exchanges, and I can avoid capital gains tax on the sales. So don't fail to think about that. If you are, a real estate investor and you're serious about building up your portfolio over time, if you're someone like me who invests through funds or syndications, very few do offer the ability to do that. So you're not going to have control when you invest passively through a fund, when they sell that property. It's very hard for funds to do 1031 like-kind exchanges. There's a lot of nuances there that make it difficult, but some do. There are a limited number of funds who do that. It's great to maybe have a few investments in those funds because those are just going to roll through, the rest of your life. And that's going to be a great, investment that you have in that fund that you're not paying any capital gains tax, and you shouldn't have been paying tax on the rental income. So this was just an overview. I got asked a lot of questions about this, in some of my other videos, and from people who wanted to understand why I always say you should never be paying tax on your rental income or your real estate investments. This is really why, whether you're doing it actively, if you're an active investor where you're going out and buying your own properties, you should be able to take advantage of all 6 of these. If you're someone who invests through a fund, it might, you might only be able to take advantage of 4 of the 6, but you can still, in most cases, or maybe 3 of the 6 if you can't do cash out refis. But in a lot of funds do cash out refis. But in most cases, you should really be looking at a situation where you're not paying tax on the rental income while you own that property. And if you own those properties yourself, you have control over the sales of when those properties are going to be sold or not sold, when there's going to be cash out refis. So you should really never be paying tax on the capital gains. So again, this is a great variation of the buy, borrow, die strategy and how you can use that with real estate. Check out my video if you don't understand that strategy. It is very important. Real estate investing is critical. If you're someone who wants to get serious about building wealth, you really need to have some allocation in your portfolio to real estate investing. So hopefully you found this video helpful. If you did, please like the video and subscribe to the channel.